Welcome back to Mark Carney's book club. This is part 4 of chapter 11 on climate change. Hopefully the last one. In this part, we're going to be looking at how the current financial sector has priced the transition away from a carbon-intensive economy. Purpose and intents are growing, though it's not moving fast enough, with financial markets only assigning a low probability of transitioning to net zero. He comments how while some energy companies project out carbon pricing for corporate planning and investments, only 15% of companies using carbon price to stress test capital investment use a forward-looking price that rises over time. Only 4% of banks and insurance companies think that climate risk is being priced correctly, and he adds that they are not wrong. Market valuations suggest that the world is on track for temperature rises by 3 to 4 degrees Celsius by the end of the century. Per Goldman Sachs, we're already seeing that the capital costs for high carbon energy projects are increasing significantly. Capital costs in this instance are capital expenditures, which are like fixed assets, so like machinery, equipment, like what companies have to invest in the infrastructure to make the revenue, not capital in that it's like money. So we're already seeing that the capital costs for high carbon energy projects are increasing significantly. Oil and gas investments are seeing hurdle rates of 10 to 20% versus renewable projects, which see hurdle rates of 3.5% for the regulated investments in Europe. So hurdle rates are the minimum required rate of return on a financial proposition for it to receive the green light. So this is showing that investors are increasingly wanting to put their money behind the renewable projects, likely because they see down the line it's not sustainable to sink their money into oil and gas projects. Capital expenditures are for assets that are supposed to have a useful life of, in some infrastructure cases, 50 years. And if the investors don't see that it's going to be a viable investment in 50 years, if it has to get just scrapped, then it becomes a stranded asset and it can no longer generate revenue. Investors are turning away from oil and gas projects, which is a good thing. I think it's important to mention this isn't just a Canada problem, it's the entire world. So as Canada looks to diversify its trade partners at this time especially, we have to show the world that we are also doing our part, because the majority of the world is. Everyone is thinking this way, and so it's not just some Canadian conspiracy, sorry to say to certain people who think it is. These high hurdle rates for getting investment in oil and gas capital projects is constraining the oil and gas industry's ability to invest. Capital expenditure commitments in new long cycle oil projects have fallen by more than 60% over the past 5 years versus the previous 5 before that. In parallel, big oil is beginning to transition to big energy. European big oils have reinforced their climate change commitment since the beginning of 2020. Goldman Sachs projects that renewable power will become the largest area of spending in the energy industry in 2021, surpassing upstream oil and gas for the first time in history. These investments encompass mostly renewables, biofuels, and the infrastructure investments necessary to support a new era of electrification in both grids and charging networks. Across the financial sector, we're seeing the incorporation of transition risk assessments. Credit agencies are recognizing that transition risks affect cash flow and credit ratings as demand for high carbon products decreases or the cost of production increases. Combination of the weight of scientific evidence and the dynamics of the financial system suggests that climate change is a major threat to financial resilience and economic prosperity. As we shall see in the next chapter, climate change is a risk from which we cannot diversify. Moreover, the window to act is finite and shrinking. There are 3 technologies needed to solve the climate crisis. First, engineering, where recent progress has been exceptional. If the remaining carbon budgets allowed sufficient time for the capital stock to turn over, much of the challenge would be met. But given the narrow window, investment must be accelerated at a warlike pace to fight what John Kerry has termed World War Zero. Second, we need political technology to force consensus to break the tragedies of the horizon and the commons. This is developing. The Paris Agreement and the SDGs set the objectives. Over 125 countries have set net zero targets. Subnational governments have made pledges and enacted plans. A variety of industry groups, from the Climate Leaders Alliance to the Glasgow Financial Alliance for Net Zero, have pledged to do their part. Momentum is building, even if more is required. Finally, we need financial markets to work alongside climate policies in order to maximize their impact. With the right foundations, the financial system can build a virtuous cycle of better understanding of tomorrow's risks, better pricing for investors, better decisions by policymakers, and a smoother transition to a lower carbon economy. A new sustainable financial system is being built. It is funding the initiatives and innovations of the private sector. It has the potential to amplify the effectiveness of the climate policies of governments, and it could accelerate the transition to a low carbon economy. It is within our grasp to create a virtuous cycle of innovation and investment for the net zero world that our citizens are demanding and that the future generations deserve. But the task is large, the window of opportunity is short, and the risks are existential. The next chapter explains how to bring the war against climate change into the heart of financial decision making. Great, so we got through chapter 11 in 4 parts. That's awesome. We will next start chapter 12, which will dive into how the financial sector will be able to accommodate the transition required to get to a net zero economy. Follow along for more. We will start chapter 12 next.